Picture this. You're sitting in a bank lobby. You've done everything right. 750 credit score. Stable job, 20% down payment, saved up over 6 years of discipline and sacrifice. You're wearing your best blazer. You've rehearsed the numbers in your head 100 times. You feel ready? The loan officer pulls up your application, types something, pauses, and then turns the screen toward you. 7.1% interest rate, 30-year fixed, on a $350,000 home. You smile and nod because you got approved. You worked for this. What you don't know, what nobody in that room is going to tell you, is that the person who sat in that exact same chair yesterday, with a nearly identical financial profile, walked out with a 5.8% rate. Same bank, same loan amount, same neighborhood, same down payment percentage, that 1.3% difference. Over the life of a 30-year mortgage, that's $97,000. Not because you were a worse borrower, not because you made more mistakes, but because of one number, your credit score, and more specifically, because of a feature of the credit scoring system that banks understand perfectly but have zero financial incentive to ever explain to you. This isn't a conspiracy theory. This is the math of how the credit industry operates. And today, I'm going to show you the exact mechanism, completely legal, completely documented, and completely ignored by the financial media, that can move your credit score by 100 points or more in under 90 days. The silent heist isn't banks charging you too much. The silent heist is banks never telling you how to pay less. My name is Ava, and I've spent 17 years in investment banking and accounting, watching people get financially outmaneuvered by institutions that speak in jargon specifically designed to keep you confused and compliant. I'm not here to sell you a course. I'm not here to give you mindset fluff. I'm here to translate robot jargon into plain English. Because the gap between what banks know and what they tell you is, frankly, one of the most expensive information asymmetries in personal finance. The strategy I'm about to walk you through is not a hack, it's not a loophole. It's a documented feature of how credit scores are calculated that the financial industry profits from keeping obscure. If this information is worth something to you, and it will be in real, countable dollars, hit that subscribe button and the like button right now. Because the next video is going to go even deeper into how banks price you based on data you never consented to share. Let's get into it. Two people, same city, one makes $97,000 more on their home. I want to introduce you to two people. Let's call them Marcus and Claire. Claire is 33. They both live in the same metro area. Both earn right around $82,000 a year. Both have responsible payment histories, no bankruptcies, no collections, no drama. Both decided in the same month to buy their first home. On paper, they're basically the same borrower. Marcus walked into his mortgage appointment with a credit score of 698. He'd been told by his bank app that was good. He felt fine about it. He got approved at 7.1%. Claire walked into her appointment with a credit score of 761. She got approved at 5.8%. Same loan size, same down payment, 1.3% difference in rate, $97,000 difference in total interest paid. Claire didn't have a higher income. She didn't have fewer debts. She didn't inherit money or get lucky with the stock market. What Claire had was knowledge of a mechanism built into the credit scoring system that Marcus had never heard of. A mechanism that she had used 91 days before applying for her mortgage. And that knowledge was worth $97,000. Here's the thing that should make you genuinely angry. This mechanism isn't secret. It's not buried in fine print. It's a published, acknowledged feature of how FICO scores are calculated. Financial institutions know about it. Mortgage brokers know about it. Credit repair companies sell access to it for hundreds of dollars. But your bank, your credit card company, the friendly app that shows you your score, they have no financial incentive to ever tell you it exists, because the longer you stay in the good credit tier instead of the excellent credit tier, the more interest you pay. And interest is how they make money. How credit scores are actually calculated and where the trick hides. Before I tell you what Claire did, you need to understand how FICO scores actually work. Not the oversimplified version, the real version. Your credit score is a statistical prediction. It's asking one question. Based on your credit history, how likely are you to default on a debt in the next 24 months? The algorithm compares your patterns to millions of other consumers and assigns you a number. That number is built from 5 factors. Here's what they actually are and how much each one matters. 35% of your score. Have you paid on time? This is the big one. How credit utilization, 30% of your score. How much of your available credit are you currently using? How old are your accounts? Oldest, newest, and average. How credit mix, 10% of your score. Do you have different types of credit? Cards, loans, etc. How new credit/inquiries. 10% of your score? Have you recently applied for new credit? Most people focus obsessively on payment history and utilization, and those matter. But notice that third factor, length of credit history, 15% of your score. Here's what most people assume about that factor. It's purely a function of time. You opened your first card at 21. You're 34 now. Therefore, you have 13 years of history. Nothing to be done about it, just wait. That assumption is wrong, and the error is exactly where the trick lives. The authorized user strategy, how Claire added 63 points in 91 days. When you become an authorized user on someone else's credit card account, that account's entire history appears on your credit report. Read that again. Not just from the day you were added, the entire history of that account, its age, its payment record, its credit limit, its utilization, all of it imports to your profile as if you had been on that account from the beginning. Claire's mother had a credit card she opened 21 years ago. Perfect payment history, never missed once. Low balance, high limit. Claire asked to be added as an authorized user. Her mother spent 10 minutes on her bank's website. 2 billing cycles later, Claire's credit report showed a 21-year-old account with perfect history. Claire's average account age jumped from 5 years to 11 years. Her total available credit increased significantly, dropping her utilization ratio. Her score moved from 698 to 761 in 91 days. She never received a physical card. She never had access to her mother's account. The addition was purely a strategic credit optimization move, and it saved her $97,000 on a mortgage. The opportunity cost math, what one number is worth over a lifetime. I want you to understand the full scale of what we're talking about, because most people hear, quote, 1-3% difference in mortgage rate and don't feel the weight of it. Let's run the math that dealerships and banks will never show you. $350,000 mortgage at 7.1% for 30 years. Total interest paid equals $499,200 to a $30 mortgage at 5.8% for 30 years. Total interest paid equals $401,700. Difference, $97,500 in lifetime interest. A higher credit score affects every single credit interaction for the rest of your life. Auto loans, lifetime, 3 vehicles. A credit score difference of 80 points equals $12,000 to $18,000 in additional interest. Credit card APR difference, often 4-6% higher for good versus excellent credit. On $8,000 in revolving debt equals $320, $480 per year. Insurance premiums, some states, $200, $600 per year higher for lower credit tiers. Over a 40-year financial life, the gap between a 700 and a 760 credit score can easily exceed $150,000 in additional costs for the exact same purchases, the exact same income, the exact same financial behavior. This is the silent heist. Not one dramatic theft, 1,000 small extractions every single year from people who were never told they could pay less. Why banks won't tell you this? Here's the uncomfortable reality. Banks and credit card companies are not your financial advisors. They are businesses. And the business model depends on the spread, the difference between what they pay you for your money and what they charge you to use theirs. Your credit score is how they determine how much of that spread they can extract from you. A customer with a 760 score has options. They can negotiate, they can walk away, they'll accept worse terms less readily. A customer with a 698 score has fewer options. They're more likely to accept the first offer. They're more likely to stay because switching feels risky. The system isn't accidentally opaque. It's designed to keep you making decisions from a position of less information, less leverage, and less freedom than the institutions across the table from you. Knowing the other mechanisms I'm going to show you doesn't just raise your score, it fundamentally changes your negotiating position in every financial interaction for the rest of your life. The 4-part credit optimization algorithm. Here is the complete step-by-step algorithm. No fluff, no believe in yourself, just the mechanics in order of impact. Step 1, the authorized user move, biggest lever, fastest result. This is what you start, what you need, a family member or very close friend who has an old credit card account. That account must have perfect or near perfect payment history, low utilization, ideally under 10%, a high credit limit, and ideally 10 plus years of age. They need to be willing to add you as an authorized user through their bank's website or app. What happens? The primary account holder logs in and adds you as an authorized user. This takes about 10 minutes. You do not need a physical card. Many people do this without ever handing over a card. Within 1-2 billing cycles, 30-60 days, the account appears on your credit report. Your score adjusts to reflect the new account's age, history, and available credit. What to look for in the account. Minimum account age, 7+ years. Older is dramatically better. Under 10% of the credit limit. Payment history, 0 late payments, ideally 0 missed payments ever. Credit limit, higher is better, increases your total available credit. Confirm the issuer reports authorized users to credit bureaus, American Express, Chase, Bank of America, Capital One, and Discover all do. Smaller issuers and credit unions sometimes don't. Verify before proceeding. The single most important thing you can do if you have thin credit history or a short average account age. For many people, this one move is worth 100 points. Step 2, the utilization timing fix. Free, immediate, often ignored. Utilization is 30% of your score. Most people understand this conceptually. Keep balances low. But they miss a critical mechanical detail that costs them points every single month. Utilization is calculated based on the balance reported to credit bureaus. That balance is reported on your statement closing date, not your payment due date. This means you could pay your credit card in full every month, never pay a penny of interest, and still be showing high utilization because you're charging $2,000 on a $3,000 limit card, and that $2,000 balance appears on your statement before you pay it off. The fix is simple. Pay your balance down before your statement closes, not just before your due date. Log into your account, find your statement closing date, and pay your balance to near zero 2-3 days before that date. Optimal utilization for maximum score impact, 1% to 3% of available credit. Acceptable range, under 10%, 50% plus can drop your score by 100 points. The beautiful thing about this fix, it shows up in your score within 1 billing cycle. 30 days, no new accounts, no hard inquiries, no waiting years. Check your statement closing date right now. If your balance is above 10% of your limit on that date, you're bleeding points every month that you don't have to be. Step 3, credit limit increase requests. Lower utilization without changing your balance. Utilization is a ratio, balance divided by available credit. Most people only work on the numerator, the balance. But you can also improve the ratio by increasing the denominator, your available credit. Many credit card issuers allow you to request a credit limit increase with no hard inquiry on your report. American Express is particularly known for this. You can request an increase through their app and receive approval using a soft pull that doesn't affect your score. If you're carrying $2,000 on a $5,000 limit card, that's 40% utilization. If you get your limit raised to $10,000, that same $2,000 balance becomes 20% utilization. A significant improvement with zero change in spending behavior. Action steps. Request a credit limit increase on every card you have that allows it. Check whether the issuer uses a hard or soft inquiry before requesting. Do this every 1-2 months. Limits can be raised multiple times over time. Do not close old accounts. Closing accounts reduces available credit and can hurt your average account age. Step 4. Rapid rescoring for active mortgage applicants. This one is specifically for people who are in the middle of a mortgage application and need score improvements reflected quickly. Rapid rescoring is a service that mortgage lenders can request from credit bureaus to update your credit report, and therefore your score, within 72 hours based on documentation you provide. Here's how it works. You pay off a credit card balance and provide proof. Instead of waiting 60 days for the normal reporting cycle, the lender requests that the bureau update your report immediately. Your score reflects the improvement within days, not weeks. Important notes. Rapid rescoring is not available directly to consumers. It can only be accessed through a lender during an active application. Not all lenders offer it. Ask your mortgage broker or loan officer explicitly. It works best for utilization improvements and new authorized user additions. The combination of steps 1-3 executed correctly, followed by rapid rescoring, can produce score improvements of 80 points during the application itself. Beyond the basics, what the credit industry doesn't want you calculating, let me go a level deeper on something that trips up a lot of people who understand the basics but are still leaving points on the table. The account age trap, what to keep, what to cut. Conventional wisdom says never close credit accounts because it hurts your score. Like most oversimplified credit advice, this is partially right and significantly incomplete. What actually matters is your oldest account's age and your average account age. Closing your oldest account can be devastating. Closing a relatively new low-limit store card you opened 3 years ago for a one-time discount, that might actually help your average account age. Do an audit of every account you have. For each one, ask, does this account improve my average account age or drag it down? If you have 15 accounts and 12 of them are newer than your oldest few, the newer ones are mathematically reducing your average. Some of them may be worth closing. But, and this is critical, never close your oldest account. Never close accounts with the highest limits, and never close anything within 2 months of a major credit application. The scoring model variation, not all scores are equal. Here's something that shocks most people when they first encounter it. There are dozens. FICO alone has multiple versions. FICO 8, FICO 9, FICO 10, and industry-specific models for mortgages. FICO 2, 4, and 5. Auto loans, FICO Auto Score, and credit. When you see your score in a bank app or on Credit Karma, you're seeing one version. The score your mortgage lender pulls might be a different model, often one of the older FICO models that treats some factors differently. The authorized user strategy and utilization timing improvements work across all major scoring models. But if you're optimizing for a specific application, especially a mortgage, ask your lender which scoring model they use and optimize for that specific version. The poverty premium, how a low score taxes every purchase you make. I want you to sit with this for a moment because it's the real reason this conversation matters beyond just mortgage rates. Research consistently shows that people with lower credit scores, even modest differences like 680 versus 720, pay more for nearly everything that involves financing or credit. Car insurance in states that allow credit-based pricing can be 50% higher for someone in the fair credit tier versus excellent. That's not based on driving record. It's based on a number. Security deposits on apartments are often larger for lower score applicants. The landlord isn't losing money on this. You are. Personal loans, auto financing, even some utility deposits. Every one of these carries a credit score premium that compounds over decades. The poverty premium on credit is real, it's measurable, and it's specifically designed to extract money from people who had the bad luck of starting with less financial runway, less financial education, or less family wealth to build credit history from. The authorized user strategy is one of the few mechanisms available to compress this gap quickly. If you have a family member who built good credit over decades, and they're willing to share that history with you, that's a form of financial education that doesn't get talked about nearly enough. What happened to Marcus and what he did about it? Let's come back to Marcus. You remember Marcus, 698 score, 7.1% mortgage rate, sitting across from Claire at a dinner party, wondering why she got a better deal on the same purchase. Marcus had never heard of the authorized user strategy. He'd never been told about statement closing dates. He'd been doing everything the bank told him to do. Pay on time, keep balances reasonable, don't apply for too many cards, and he'd been told his score was good. When he found out what Claire had done, he did the math. His mortgage application was 6 months out. He had time. Here's what Marcus did. He asked his father, who had a credit card opened 24 years ago with perfect payment history and a $22,000 limit, to add him as an authorized user. His father had never used the card much. The balance was under 3%. The addition took his father 8 minutes on the bank's website. He checked his statement closing dates on all 3 of his credit cards and realized he had been showing 38% average utilization on his statements, despite paying in full every month. He set a calendar reminder to pay balances to near zero 4 days before each closing date. He called 2 of his credit card issuers and requested limit increases. One used a soft pull and approved him for a $5,000 increase. The other required a hard inquiry, so he decided to wait until after his mortgage closed. 61 days later, his score was 749. He went from 698 to 749 in 61 days. He walked back into a mortgage lender's office, different lender this time, because he'd learned to shop, and came out with a 6.1% rate. Marcus's original projected total interest, 7.1%, $499,200. $415,000 savings, $84,100. From 61 days of work that cost him nothing but time and a few phone calls. Marcus didn't become a financial genius. He didn't find a loophole, he just learned how the system actually works, instead of how banks want him to think it works. That's the difference. That's always been the difference. What destroys your optimization, the mistakes I see constantly. Mistake number 1, applying for new credit while optimizing. Every hard inquiry temporarily reduces your score by 5 10 points. Every new account reduces your average account age. If you're executing an authorized user strategy or utilization optimization, do not apply for new credit simultaneously. The two moves work against each other. Wait until your score has improved and you've locked in whatever major application you are optimizing for. Then, if you want new credit, proceed. Mistake number 2, choosing the wrong authorized user account. An account with any late payments imports those negatives alongside the positives. An account with 70% utilization makes your utilization worse. Do your due diligence before being added. Ask the primary account holder to check their current balance as a percentage of the limit, the full payment history, any missed or late payments, and the account opening date. If any of these are unfavorable, wait for the right account or find a different primary account holder. Mistake number 3, inconsistent utilization timing. 1 month of forgetting, one billing cycle where you're showing 45% utilization can undo weeks of optimization. Set a recurring calendar reminder 5 days before each statement closes. Make this automatic. Mistake number 4, closing old accounts after a score improvement. This one sounds counterintuitive, but I see it constantly. Someone improves their score, starts cleaning up their financial life, and decides to close all the old cards they don't use anymore. They close the 12-year-old store card. They close the 8-year-old secured card they opened when they were rebuilding. Suddenly, their average account age drops and their score falls 2040 points. Old accounts with no annual fee, leave them open. Use them once every 6 months to prevent the issuer from closing them for inactivity. But never close them unless there's a compelling fee-based reason to do so. Mistake number 5, confusing Vantage Score with FICO for mortgage purposes. The score you see in your banking app is almost certainly a Vantage Score or a consumer-facing FICO version. Mortgage lenders typically use FICO 2, 4, or 5 older models that can weight factors differently. Your consumer-facing score going up doesn't guarantee your mortgage score went up by the same amount. Before any major application, ask your lender which specific scoring model they use and whether they can pull a preview of that score before the formal application. This lets you know exactly where you stand under the model that actually matters for that specific transaction. This isn't just about your credit score. I want to zoom out for a moment because the credit score conversation is actually part of a much larger pattern. The financial industry profits from information asymmetry. They profit from the gap between what they know about how their products work and what you know. Every complex term, every piece of jargon, every system that requires specialist knowledge to navigate. These are features, not bugs, of a system designed to extract maximum value from people with less information. The authorized user strategy isn't special. It's been documented in financial literature for years. Credit repair companies charge $500, $800, sometimes $2,000 to walk people through it. It's just not marketed to you because marketing it doesn't benefit the institutions you interact with financially. This is why financial education matters so disproportionately. It's not just about feeling empowered or knowing your worth. It's about measurable, calculable, bankable differences in what you pay for identical products over the course of your financial life. Marcus and Claire are a binary, but the real-world version of this isn't one single decision. It's the accumulated impact of 1,000 small moments where having the right information let you negotiate from a position of strength instead of desperation. The wealth gap in America isn't just about income. It's about who knows the rules of the game and who has been told just enough to keep playing without understanding what it's really costing them. Financial literacy isn't a personality trait. It's not something some people are born with. It's information, and information can be learned, shared, and used. That's what this channel is. The choice is yours. Let me be direct with you because you've been here for 30 minutes and you deserve directness. Right now, if you have a credit score under 700 and there's any possibility you'll apply for a mortgage, a car loan, or any significant financing in the next 2 years, you have work to do. The mechanisms exist. They're free, they're legal, they're documented. The only variable is whether you do them or not. Here's your action list. Not someday, not next month. This week, 1. Today, pull all 3 of your credit reports for free at annualcreditreport.com. Know what's actually on them. 2. This week, find your statement closing dates for every credit card you carry. Set a recurring calendar reminder to pay balances to near 04 5 days before each one. This week, identify one family member or trusted friend with an old, clean, high-limit credit card. Have the conversation. Ask to be added as an authorized user. 4. This month, call your credit card issuers and request limit increases, starting with the ones that use soft pulls. 5. Before any major application, Ask your lender which FICO model they use. Make sure your optimization work is reflected in the model that matters. The person who does these 5 things is Marcus at 749. The person who doesn't is Marcus at 698. The difference isn't intelligence. The difference isn't discipline. The difference isn't luck. The difference is whether you took 15 minutes this week to do something the bank was hoping you'd never know to do. Your future self is sitting across from a loan officer right now, in a future that hasn't happened yet. The score they're looking at is being built right now. Banks don't want you to understand this simple trick, but now you do. What you do with it is entirely up to you.